This is the deficit to GDP. Do you worry, Professor Feldstein, that we go out further than the agony of the 80s that you lived with the White House, and as Holtz-Eakin says and Elmendorf say, we get out to 6, 7, 8% deficit to GDP?
I think that's unlikely, but I still don't like the deficits that we have even at 3.5%. But I think you have to see these deficits and the deficits during the coming decade, you have to see them in the context of what's being achieved by the corporate tax reduction and the inflow of capital from the rest of the world.
Will we get growth from that will make that denominator and deficit to GDP less painful?
A little bit, but if you ask why are deficits a bad thing, one of the reasons is that they crowd out private investment. But we're going to have so much capital inflow from the rest of the world and from U.S. firms bringing back capital, that'll outweigh the effect of the crowding out.
We're going to rip up the script and pretend it's Act 10 where you change on a dime. Does that mean a strong dollar? Is the president's worst nightmare a Plaza Accord dollar strength?
I think we will see a stronger dollar.
Will we see a Plaza Accord kind of standard deviation move in strong dollar?
No, I don't think so.
Okay, I want to show this next chart because Martin Feldstein lived this. This is the debt to GDP, stock and flow. I stole that from Professor Feldstein. The green circles, Martin Feldstein at the White House with the Council on Economic Advisors a few years ago. We're not where we were then, sir. We're at 40-some% debt, and now we're up here at 100%. Does the president and his group understand that?
I don't know what they understand. I don't know where this 100% comes from. The Congressional Budget Office says that number. Is that supposed to be now or in the future?
I think it's like here. It's a summation of the debt.
No, I
whether
understand.
Whether you look at 70% as a pure debt, or you look at 100% with some add-ons, or like Kotlikoff, that renegade over at BU, you look all in. I mean, it's a lot of debt.
It's a lot of debt, and it's a bad thing. But I would say that the growth in that debt that we can expect over the next 10 years, $1.5 trillion, about 5% of GDP. So it would add about 5% to the debt to GDP ratio.